And welcome to the Aaron Kantzman Show. I'm your host, Aaron Kantzman. We're here to speak to you about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you've got any questions or comments, feel free to email me at Aaron, A-A-R-O-N, at Lighthouse with an L, lighthousecapital.co.il. That's Aaron at lighthousecapital.co.il. You can check me out on the web at www.aaronkantzman.com. That's www.aaronkantzman.com. Be sure to follow me both on LinkedIn and Twitter, and of course, subscribe to our YouTube channel. So I want to speak today. It's going to be short, okay? I want to define some investment terms. I want to give like four investment I would call financial terms, let's say, that I think everybody should know, and not everybody does. And sometimes certain terms get thrown around. I just want to make some order. So we're going to speak to you about four financial terms, let's say, that everybody should know. The first one, okay, number one, compound interest. Okay, perhaps I would say the most important aspect of investing and the most dangerous aspect of debt is compound interest. What is compound interest? Well, according to Investopedia, compound interest or compounding interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. Now, for you historians, thought to have originated in 17th century Italy, compound interest can be thought of as interest on interest. In Hebrew, we say rebit al rebit, and will make some grow faster rate than simple interest, which is calculated only on the principal amount. So what I want to do is I want to give you an example, because I think the example will help clarify a principle which can be sort of complicated. Let's say you put $10,000, $100,000, okay, in the bank, okay, and you're going to be guaranteed 5% a year for, let's say, 10 years. So I'm going to ask you a question, okay? You can all feel free to email me the answer. Just kidding. Okay, so you get $10,000 at 5% for 10 years. Okay, what does that mean at the end of the day? Okay, you're going to end up getting every year $5,000. Okay, so at the end of 10 years, you will have made $50,000 in interest over 10 years, plus the initial deposit you have. Okay, but let's just turn that around a little bit and say, okay, I'm depositing $100,000, but instead of getting a fixed rate of 5% annually, I'm getting a 5% compounded return. Okay, what's that mean? That means that in year one, okay, I'm going to have $105,000, but in year two, I'm not going to get just another $5,000. I'm going to get $5,000 on my $105,000. Okay, which comes out to like another $7,500, something like that. At the end of the same, excuse me, 10-year period, I'm not going to end up having $150,000. I'm going to end up will have made almost $65,000, $64,700, something like that. Okay, so you can see how much more substantial it is when interest is compounded. Instead of me having $150,000 at the end of a decade, I now have almost $165,000. Okay, that's huge. Now, don't think all is rosy, right? Let's just say that you're compounding interest, which you do when you take out debt. Okay, so instead of sort of on the investment side spiraling up, what compounding interest means on the debt side means you're sort of entering the black hole. You don't want to do that, because that's how you really build up debt super quick. And obviously that's the goal of the show, right? Is for you not to do that. We don't like debt. Okay. Next term that I think we should know about is called, excuse me, I don't know what it is today. It's called net worth. Okay. What's net worth? Okay. It's simple. Net worth is the difference between your assets, right? It could be your property, your home, your investments, your savings, and what you owe, your debt, okay, your liabilities. So you can calculate your net worth by adding up all the money that investments you have, right, including the current market value of your home and your car, as well as the balances in checking, savings, retirement, any other investment accounts that you might have. Then subtract all of your debt, which could be your mortgage, credit card debt, home equity loan, car loan, all those bad things we don't like, including the mortgage. We like the mortgage, right? I don't mind the mortgage. It's pretty much the only debt that I'm a fan of. But you subtract that from all the assets that you have, and the resulting number is your net worth, right? That helps you know sort of what your financial situation is. Okay, I once met with someone who owned like 8 properties in Jerusalem. Now, for those of you outside who don't really know what Jerusalem real estate means, and in prime locations, okay, 8 properties, this goes back 15 years, okay, so it's not exactly what it is today, but even then, 8 properties, you're talking about probably close to, let's say at that point, we're talking about around $3 to $4 million worth of property. And the first time I met them, it was shooting out money. I was like, wow, you guys are doing great. Until they told me that they had about 80% debt leverage on all of them. Okay, so they really didn't have a $3.5 million, 3.5, let's just round it up, right? Take the middle number of net worth, right? They had significantly less. They ended up having like $300,000 or $400,000 of net worth and a boatload of debt. So sometimes if you just look at the asset side of things and say, wow, I'm rich because I own all this property, or I've borrowed a lot of money, but I've invested it, right? I've used margin, I've got all this money in the bank. Well, that's only half the equation, right? You've got to figure in also how much money you owe, what your liabilities are, and that gives you a true picture really of what your financial situation is. And we want to be truthful, right? We don't want to fool ourselves financially, because that only ends up really costing us down the road, especially in retirement, right? If we make a plan, if we make a financial plan based on inaccurate information or false information, we're gonna be up the creek when it comes time to retire. I can just tell you that right now. Seen lots of people make those mistakes. Don't want to do it, okay? Term that you got to know, number 3. Asset allocation, okay? How your money is put to use, how your money is divided up, okay? We've spoken about a lot of times. There are 3 major asset classes: stocks, bonds, cash. Each of these assets reacts differently to conditions, to markets, what's going on in inflationary times, and bad markets and good markets, bad economies and good economies. So what you want to do, obviously, is first do a financial plan, right? Understand what your risks are, what your tolerance for risk is, what your goals are, what your needs are, and then you're able to sort of break up the money, allocate the money correctly so you can achieve what it is that you're setting out to do, which is your goals and your needs. For example, and this example is brought to you from an article on CNBC that ran a few years ago. Investing in stocks can give you strong growth over time, but they can also be quite volatile. Thus, one of the most common pieces of investment advice out there is to diversify your portfolio, or put your money in several buckets to make sure you're risking as little as possible while still achieving your particular goals. I would probably define it a little bit differently than that, but that's good enough for the show. Okay, so number 3, we've done first, right? Compound interest, term number 1 that you need to know. Very important term. Number 2, net worth. Number 3, asset allocation. Number 4, and this is also important because I think I see people making mistakes with this, capital gains, okay? Why are capital gains important, or to know the term? Because unless it's in a retirement plan, I've seen lots of people make lots of money in investments, but when they're making their plan, they forget that, well, if we sell it, we might have to pay tax, okay? Now, I'm getting into an area that's not my specialty, I'm not licensed in it, so obviously you have to speak to a certified accountant to speak about tax issues, but just as something that you wanna sort of on the surface, right? Capital gains, what is a capital gain, right? It's the difference between how much you paid for something and now what it's worth currently. Let's say I bought shares in, I don't know, let's just say Microsoft. For all you regulators out there, I'm not recommending anybody buy shares of Microsoft. I don't own shares of Microsoft, okay? I'm just using Microsoft as an example, okay? Let's say you bought Microsoft 10 years ago at $50 a share, okay? And you decide to sell it at $250 a share, okay? So you've made a lot of money, right? You make $200 per share. We're not living in a vacuum. If that's not in an IRA account, right? Once you do that, that triggers a tax potential, and that's a big tax, okay? Now, the gain, however, is only on paper until you actually sell the asset. The flip side of that is a capital loss, right? Where the asset you bought decreased in value from the time you purchased it. Now, what you can do to be more tax efficient is take those losses and offset them against gains you might have. That's called tax loss harvesting, okay? That's very important. That's actually a really, really important way. And I think I've done videos on it. We'll certainly do videos in the future. Ways to save yourself huge amounts of money, okay? Being smart, being efficient when it comes time to selling assets in a portfolio. Because if you do it wrong, you're going to cost yourself a lot of money. And something I see a lot of do-it-yourself investors do. They say, well, you know, I need $30,000. I'll just sell, right? And what they end up doing, I'll tell you, they make the mistake. They sell their winners, and that triggers a big tax cost because we have this sort of psychological barrier that we can't sell our losers. In fact, probably one of the most common things I hear from do-it-yourself investors is, well, you know, I bought the stocks, they dropped. I'm only going to sell them once they get back to the price I purchased them for. I would say, bad strategy, right? You tend to want to ride your winners and dump your losers. Okay, so that's really important. It's really important to be smart when you're selling because it can trigger huge a tax bill, right? And we don't want that. We want you to keep as much of your money as possible. Keep in mind that different countries treat different types of gains differently, right? The US differentiates between long-term gains, which is anything over a year held, and short-term gains have different rates. Israel, for example, doesn't have that, that doesn't distinguish between the two. So obviously I can't urge you enough to contact your accountant to make sure that you're doing things correctly. But remember, capital gains are important. It's important. You have to be strategic when you need to sell something in your portfolio. So it's important to know the term capital gain. So in review, we've had 4 financial terms that you need to know. Term number 1, compound interest. Term number 2, net worth. Term number 3, asset allocation. And coming in 4th, ladies and gentlemen, capital gains. That's right, capital gains. You have been tuning in to the Aaron Katzman Show, where we speak to you about your life, your money, and your investments. If you've got any questions or comments, feel free to email me at Aaron, AARON @lighthousecapital.co.il. That's Aaron at lighthousecapital.co.il. You can check me out on the web at www.aaronkatzman.com. Be sure to follow me both on LinkedIn and Twitter. And of course, tell your friends. We need subscribers. I'm begging you. We're going to do a telethon, Jerry Lewis telethon, okay? To get subscribers to the Aaron Katzman YouTube channel. Please subscribe to the channel, okay? It's been a pleasure speaking to you, and we'll talk to you soon.